Some lithium prices have dropped as much as 60% from a year ago. Does the metal still work for investors? I'm with Joe Mazumdar. He's editor and publisher of Exploration Insights. Welcome back to Kitco, Joe.
Thank you very much for the invite there, Mike.
Joe, does lithium still work for investors?
Oh, absolutely. With the growth in the EV batteries, by 2040, 74% of the demand for lithium will be just for the batteries. And a lot of the battery chemistries have been evolving, but it seems lithium is sort of stuck to its volume of about 11% of the battery chemistry. So that demand is real. And I think near term, we're having issues with a few commodities as China is starting to ramp up. And, those near-term inventory issues probably had their weight on lithium. And everybody I talked to when I was looking at lithium last year was expecting a drop in the lithium carbonate equivalent prices. And that happened, probably a little bit more severe than some people thought. But most of the developers and producers I talked to were expecting some kind of drop.
Now, Exploration Insights guides investors in resource investments. Maybe you can guide us in the lithium landscape, Joe. It's roughly broken down between brines, clays, and hard rock, correct?
Yeah, so the brines, the largest reserves are in Chile, and that's all brines. Geologically, brines are basically these big lakes that have formed, basically eroding all the nearby rocks, and some of these rocks have a lot of lithium in them. These lakes evaporate, and they concentrated in the elements that such as lithium, and they get basically in the sediments underneath that lake as it's drying up, and so parts Chile, Argentina, Bolivia, what we call the lithium triangle, is basically all these lakes being uplifted because of the Andes drying, creating what we call these salars, and those are the brines that people are extracting. The other major source is in Western Australia are the hard rocks, either the lithium pegmatites. And then clay stone, I would say Thacker Pass is the biggest example, and that's the one in Nevada, which is being advanced by Lithium Americas.
Now, is everything in Nevada? I mean, there's all the Ioneer, I always get them mixed up, Lithium Americas and Americas Lithium as well, too, that they have beside. They're all type of clay as well out of Nevada?
Yeah, I would say right now the clay stone has been held back a while because it's not the mining there, it's the metallurgy, because these happen in these volcanic environments like Thacker Pass is within the McDermott caldera. There's a lot of these acidic fluids that leach these elements out of the rocks, and one of them is lithium. And but it forms in these illite clays, and so the lithium molecule is basically replacing aluminum, magnesium, and that in these clays. And so the problem is basically breaking up that structure of that mineral and extracting the lithium. And so it's really the metallurgy that really that makes those deposits problematic, and that's where all the capital goes.
Just to emphasize that point again, so extraction may be easy, finding it may be easy, but when you actually have the ore, the material that you're going to process is just bound together in a way that makes it harder to actually extract, so it's going to be driving up the costs.
Yeah, the mining, at least with claystone at Thacker Pass, is free digging. So, I mean, it's just a shovel blasting. And so the mining cost is very low. The upfront mining development is very low. Like 76% of the upfront capital, which is like over 2.2 billion, is plant related processing, because you need a lot of sulfuric acid, and they require a sulfuric acid plant to make that sulfuric acid for the processing facility. And that also takes a lot of power. And so that is what's driving all the costs and the technological issues with those kind of deposits.
What could be some drawbacks with brines, Joe?
Brines is basically the environmental impact, because basically you're taking, these are porous sediments, and you're taking the brine that's in them, pumping them up. That's where, your mine development is basically just pumping and then bringing the brine up. And then you build these huge ponds. So a quarter of the capital required for a lot of these projects that, are $500 million are for these big, huge evaporation ponds. And that's how they basically concentrate the brine in lithium before sending it to the processing plant to filter out the deleterious elements that they want to get out, like, magnesium and sodium and other things. So all that water is gone. That's the environmental impact. But the positive for them, they produce a lithium carbonate at site. So it's sort of like, like a gold mine producing, all you're doing, and then you produce a gold bar. You're almost to the final product that the battery manufacturer would use. The issue is they're developing new technologies like direct lithium extraction, which basically puts the brine through a membrane, and that membrane takes out the deleterious elements and just takes what it wants, which is the lithium. And lithium is big, and so it can capture lithium and not the other deleterious elements, and lets the water go. And so the water can be pumped back in to the salar, which environmentally makes a lot more sense. And then also capitalize, you don't have these big, huge evaporation ponds.
I guess the issue with DLE is we just haven't really seen it at a scale right now. It's just because...
commercially, we've seen it at a pilot plant. So Lilac has done it at pilot scale, and which is one thing that drove up, I think it's Lake Resources, which is who's doing it at the Cachi Salar in northwest Argentina. Lilac is out of California. And so, yes, we've seen it at the pilot scale, but now we're talking commercial, which is much bigger scale, and at the operational site, which should be in northwest Argentina. So, we're all waiting to see how that works. But if that methodology processing works for all brines, then that would introduce a new way of doing it without requiring all the evaporation ponds and taking the water out, which is what a lot of the environmentalists complain about.
Now, we talked about brines, and we mostly associate with the lithium triangle down in South America. We talked about clays, which we see around Nevada. Let's talk a little bit more about hard rock. So, and that's classic with Australia, but we've certainly seen some junior names that have performed very strongly up in Canada. Those would be typically your types of hard rock, correct? And maybe you could talk a little bit more about maybe trends. Is there a Abitibi up there, or is there any types of areas that are important for hard rock in Canada?
Okay, so the terrain where you get the lithium-bearing pegmatites, can be older terrains and not very young rocks. And so besides Western Australia, one big development project we're seeing right now is in Brazil with Sigma Lithium. That's, on the border of being into production. That's hitting new 52-week highs. We are seeing the consolidation between Alchem and Livent, which is, I think, a multi-billion-dollar consolidation. But it would make it, by, I believe, almost 2030 or something like that, the third biggest lithium producer. And so we're seeing a bit of that consolidation that we're seeing in base metals and in precious metals at the higher levels. We're seeing it in lithium as the price is rebounding. What's happening there is for Alchem and Livent is there's a lot of infrastructure required for these lithium pegmatites, because basically you're taking 1.5 to 1.5% lithium oxide, which is what the hard rock grades. You're mining it. All the ore, the lithium oxide, is within the pegmatite. It's not outside of it. It's just in the pegmatite. These pegmatites occur in swarms. And so what's happening is these granite intrusions, these felsic intrusions, are basically crystallizing. The last bits of the crystallization introduce volatiles, and one of those volatiles could be lithium. It concentrates in these late dikes, which are called pegmatites, and these lithium, the lithium oxide content of the spodumene is about 8%, but that doesn't form all of the dike. And so if it forms, let's say, 30% of the dike, that means you've got like 2.4% lithium oxide in that dike. But usually once you dilute everything, you're talking about 1 to 1.5%. But then you upgrade it, and the upgrade's not that much. It's only going to 5.5 to 6%. And hence the idea that you need a lot of infrastructure to get that concentrate out. So infrastructure is key in making those things economic.
Talk about that infrastructure then, Joe. So you're saying that the percentage amount of lithium that actually the miner is going to be getting out is going to be quite small. So they're going to be shipping a lot of material to the refiners from where their project is located. So if you're assessing a project right now, you're assessing somebody that is advancing a project right now, what types of infrastructure do you kind of need to see nearby, and how do you actually assess those costs?
So if I was looking at a lithium dike, sort of proposition, I'd be looking at the density of those dikes and looking for dilution with respect to the head grade and the strip ratio, because some of these strip ratios are 15 to 16 to 1, a lot of waste. And so where's that going? Is that going to be hard to permit? Some of these mines, like the Kathleen Valley, which the grade doesn't really change that much from open pit to underground, but the question, the strip ratio goes crazy, and so their open pits are very, very shallow, and they go straight into underground with head grades of about 1.3, 1.4% lithium oxide. But that's because of the big amount of waste, and so that's one thing to be considered when you're looking at that. And then it's the infrastructure, because basically what you're doing at the plant is not rocket science, and so there's really not a lot of technical risk there. The thing is taking that on rail, by truck, whatever, to a port. And the thing is to get it to the port as quickly and as cheaply as possible. So that's the kind of infrastructure you're looking for. For Sigma Lithium, the infrastructure is very good in Brazil. The capital intensity in places like Quebec are higher because the infrastructure isn't there, but there's a lot of support by the local government and others to build that infrastructure. So in Quebec, it seems to be, developing some kind of infrastructure, not only for the mining, but potentially getting it all the way into the battery quality levels like the lithium hydroxide or the lithium carbonate. So if we go back a step, lithium brines produce lithium carbonate, which a battery manufacturer can take. Claystone, what they're doing at that plant, would produce a lithium carbonate that a battery plant can take. Spodumene dikes don't. They usually ship, like in Western Australia, to plants like in China, which has the highest manufacturing capacity to process these lithium concentrates. And so you have to get it there. But now people with the segmentation of the supply chain want more of that built in friendly countries like in Canada and others.
We've been at this a while, Joe, and that's been a real change. The amount of government support that we see that's coming in for mining, but it's been coming around strategic minerals, and just because of that cleavage you see between Asian markets and Western markets. You cover the gold side, and we know how hard it is for those people to be raising funds. But on the flip side, with the Inflation Reduction Act, and then also what's been introduced by Europe, what also has been introduced by Canada, there's just a lot more government support, and there just seems to be a lot more financing options for some of these companies.
Oh, absolutely. A perfect example, I mean, there's a number of examples, but a perfect example would be Lithium America. So Lithium Americas has two main projects. One is the Cauchari-Olaroz brine project in northwest Argentina, which is a joint venture with Ganfeng, which is one of the biggest lithium producers out of China. But then they have Thacker Pass, which is all theirs, and that's in Nevada. But to basically get the funding from third parties like General Motors and potentially the Department of Energy, they need to basically split the company so that there is no China involvement in that new company. And so that's what they're in the process of doing. They'll keep the joint venture in a different company in northwest Argentina, and then they'll have another company that's just got Thacker Pass and does not have a joint venture with the Chinese. And then also you'll see more of those government plays, whether it be the Canadian government or even the U.S. coming into places like Quebec and that to help out with sometimes not so much the mine development, but more so the processing capacity. They want to build processing capacity locally. That's a big That's a big deal for them. And I think that's very important because over 20 years, China has built up all the processing capacity for things like lithium and rare earths.
Joe, what's the interest in lithium? How would you compare it, say, to precious metals? I'm talking about investor interest right now, or people reaching out to you, or people more interested. When has that interest arisen?
Well, I guess right now it's like there's not a lot of interest in the retail market for anything. A lot of people are like wary of where the market is right now. They're worried about recession, and a slowdown and a potential, a hiccup in the rebound that China is, undergoing right now from the COVID restrictions of last year. That's sort of weighing on commodities, as we saw last week and continue to see. So people are more worried about that. But, for me, I'm looking at all that consolidation as industry looks at this might be the moment to actually acquire. And so M&A is picking up. The other thing would be to watch for, financing risk being alleviated by these government organizations that are coming in to offer money where banks aren't there, where other traditional sources of financing are no longer there. Like we have a banking crisis in the background, but the money is there for these projects, and more so for the development projects right now. As people want to build battery plants, they want to get the car manufacturers locally, and then getting the actual mineral, because North America is blessed with big repository of minerals, and so the problem is that we haven't built a lot of processing capacity here.
What are some ideas you think work in the lithium space, Joe?
Well, I mean, I've always liked Sigma Lithium, but that's hitting new 52-week highs. So I would be looking at new lithium plays that have the components that we were talking about. High density of dikes if it's Hardrock, low strip ratio, which you can get, or they go underground, and good, excellent infrastructure. That would be a key. With respect to the brines, the lithium triangle is where you want to be. Chile wants to nationalize lithium, so that's a little bit more problematic. Northwest Argentina is probably preferable right now.
Joe, lastly, I just want you to put on your gold hat. You did work for Newmont many, many years ago. It looks like it's just swallowed Newcrest. So you have the number 1 gold miner is going to be taking ownership of the number 8 gold miner. There's going to be a big presence by Newmont right now in our home province, British Columbia, with the assets that are run by Newcrest up in the Golden Triangle. I'm thinking about Red Chris and also Pretium. Thoughts on what's happening right now in the gold space around that Newmont-Newcrest acquisition, Joe?
Yeah, I would say I was less complimentary about their acquisition of Goldcorp and their ceding of the majority of the Nevada gold mines to Barrick. I didn't think that was a really good transaction where they ceded the operatorship of the Nevada assets to Barrick at the same time acquiring a lot of probably overvalued assets from Goldcorp. This acquisition for me makes a lot of sense. They get copper exposure, and importantly, they get block caving expertise, which totally changes their framework of what makes sense and what doesn't make sense for future development and potential for future M&A. But they have a lot of assets that they acquired from Goldcorp that are these low-grade copper gold porphyries in Chile that may be amenable to block caving that maybe they hadn't looked at before, and because their expertise wasn't at that level. And Newcrest is very active with respect to exploration, doing joint ventures, doing equity placements that Newmont is not always there with. And so that'll be interesting to see where they go with that as well with respect to their future pipeline.
I was also, with the rationale for the tie-up with Agnico, was talking about what they were doing with ESG, and also having how would you say, being on part of the Quebec electricity grid for actually having like a lower cost, or I should say a lower impact gold. So I'm just also kind of wondering if also Newmont kind of gets that advantages to being tied in with the hydropower grid up in BC.
Yeah, no doubt. And also, I think their exposure to power in New South Wales as well is a bit greener there. But I like also the diversification. I mean, because the whole idea here is to get to that size where you're a significant step from Barrick, from your second major competitor. There's not going to be this incremental, oh, hi, I'm bigger. No, I'm bigger. This is like huge. And so that step is a bridge too far, I think, for Barrick. And I don't think that's something they're interested in doing. We'll see more consolidation for sure in the lower levels. And what I'm hoping to see is more consolidation or acquisition of the single asset developers like we saw with Beat Gold. Sabina, the gold fields, acquisition of 50% of the Windfall project to develop those, because those are the ones that are really languishing because of the financing risk, because gold is not seeing the input or the ingress of capital from government sources, obviously, for critical minerals. So, I like the acquisition expertise with block caving, more copper exposure, more safe jurisdiction exposure, obviously, with what they have in Australia, and also exposure to the Australian dollar, which is a nice hedge against gold as well. And again, the whole idea here is not to compete against your Barricks anymore, it's to compete directly with the ETFs, but to offer those ETF investors a stable dividend, which, generating more cash flow from diversified sources jurisdictionally as well as commodity-wise will enable you to do.
Joe, thanks for your time.
Okay, thank you very much.
He's Joe Mazumdar with Exploration Insights. My name's Michael McRae, and you're watching Kitco Mining.